Just waiting for the green light here on YouTube, and then we'll get rolling. All right, we are good to go, my friend. Take it away, Sir Wade.
Hey, thank you very much. Hey guys, this is Wade Cordell. If you don't know me, I'm the funding director for the Bank Breezy platform. Been doing that since day one. Love this company. Dave and I contacted each other and began communications about 10 or 11 years ago. Been with him side by side for about 9 years. I too and my wife have our own broker organization, and I can tell you, um, my wife is a person who doesn't like to go just walk up and start talking to folks. So she has really mastered this program and saw how simple it was to talk to business owners, and she understands because her and I had businesses and we had to use this kind of capital in the past. So I vaguely knew about it. I actually became invested in this industry a while. I love it. EAC's got a system in place that I have never seen like the likes of anywhere within the industry, and I know this industry inside and out. But our whole goal is to make sure that small business people are serviced in the area because 9 out of 10 of them who walk into a bank, they can't walk out with $10,000, and cash is king when you're trying to build a small business. So David Allen Capital has a mission of doing one thing, and that is getting the Bank Breezy platform in front of every small business in America. They may not need it today, but 7 out of 10 of them are going to need it over the next 6 months. Today's story that I'm going to talk to you about is actually a solar company in Illinois. The broker is iFinancial. Now, this particular client operates in what I consider one of the most challenging industries to finance in all of the revenue-based funding industry, which is the solar industry. Now, many lenders kind of view solar companies as high risk due to number one, fluctuating project timelines, inconsistent cash flow, long customer payment cycles, and then of course elevated chargeback concerns that they actually experience in this industry. And as a result, many of the funding requests for this industry never even reach underwriting stages because the companies just have a bad taste for it. In this case, the client actually only had an average credit. He's looking for 50,000. He needed to fund an upcoming solar installation project. To make the file even more challenging, approximately 90% of the company's revenue was received through Zelle payments, which often requires additional underwriting review because these payments are almost impossible to track, like a credit card payment would be, an ACH, and that sort of thing. But despite all these obstacles, the Bank Greasy platform actually leveraged all of our lending partners, and we were able to come up with a 40,000 flex rate funding offer with a 10-month term, and we presented that offer to the client. They are in the process of signing the paperwork, and hopefully we'll have that funded today. So that is our funding story, and I don't have but about 15 minutes, so I am going to share my screen and go over what the topic that I want to talk about today, which is different tier lenders that we have. Can you guys see this, McGuire?
I can. Yep, just waiting. There you go. Full screen. We're looking good.
All right. Well, the Bank Breezy Funding Platform uses a multiple set of lender tiers, and I'm going to start with the A-tier lenders and what they look for. First of all, an A-tier lender is going to be explained over the next couple of slides, and what they really look for in a client is an established business, one that's been there at least 2 years. They got growing revenue. They're in a stable industry. They have strong credit, and usually that's 680 plus FICO. They don't have any recent bankruptcies. They don't have any major collections. They got a pretty clean background. They got strong cash flow and consistent deposits. They got stable monthly revenue, and they got healthy ending balances on a daily and monthly basis, and very few, if any, negative days. A-tier lenders have preferred industries that they want to work in, and the most prominent ones are medical, any kind of professional service like a CPA or insurance, any type of manufacturing, retail, which is thousands and thousands, well, really probably billion or so people out there, home service companies, B2B companies, and construction companies. A-tier lenders are generally backed by institutional capital. They're backed by banks, hedge funds, but mainly warehouse credit facilities. This is where these big organizations, there's not individuals that are putting their money in it. These are institutional money. And their number one objective is to preserve capital while earning consistent returns on their money. Then you have the B-tier lenders. They look for businesses that are generally healthy, but don't quite meet the strict requirements of an A-tier lender. And some of the examples include they got a 620 credit score. They may have just one slow revenue month. They got several NSF charges, but nothing significant. They may even have existing MCA positions, and they've been in business less than that 2-year period that A lenders are looking for. B lenders look at bank statements really heavily, and the guidelines they use are generally what they accept, or they'll accept some overdraft. They'll accept several negative days, seasonal fluctuation, moderate daily balances. What I mean by that is they're not zero, but they're more than a couple $100 a day, daily balances. And any kind of existing funding that's already out there in that bank statement, they generally are okay with that. Their strategy is fewfold. Number one, they want to accept moderate risk. They understand that. Number two, they price it accordingly, whatever the risk is. They generate higher yields than an A lender because they're higher risk. In other words, you may get a 115 factor rate with an A, and that same file, because of some issues they have, the A can't take them. They may get a 130 on that same file. So the price, they have to price it accordingly. Generally high yield. Oh, I just went over that. Excuse me. And then they build customers who eventually qualify for A-tier financing. Listen to what that means. You get a B lender that comes in and they give this guy who could not qualify today for an A-tier rate of a 115 to a 125. They give him a funding, and as long as there's consistency in that, it's going to give them credit within the industry itself. So the next time an A-tier lender can look and say, hey, look, these guys actually paid that off and they were consistent and they're doing well. So the whole goal is to move them up to an A-tier. C and D tier lenders, these are the bottom of our lending tiers. These lenders specialize in helping businesses that almost all the traditional funders decline. Examples include credit scores below 600. Maybe they got some recent tax problems that they really need to fix. They probably got multiple MCA positions already in their portfolio in their bank statements. They got numerous NSF charges. They could have heavy daily ACH activity. In other words, there's a lot of money coming out of their account every single day. They got young, it might be a young business, it might be 4 to 6 months old. And they can be part of a lot of challenging industries, like I just showed you with the solar. C and D lender bank statement characteristics are commonly seen like this. They may have negative balance days. They may have some daily overdrafts. They may have some revenue fluctuation from one month to the other. They could have some existing collections. I'm not talking about collections with daily and weekly positions like ours. I'm talking about just collections in general for other situations they may have, like the car payments, the house payments, credit card payments. They could be in collection. They may have several open funding positions. They probably have a high utilization of capital. In other words, We try to keep it below 35%. They may be closer to that 37% of their total revenues going just to pay off these types of funding. And then they may have thin cash reserves on hand, which means that their bank statement ended with a couple $100 or 1,000 or less at the end of the month. Why they concentrate on high risk clients is this. These lenders understand that many business owners have temporary cash flow problems rather than a failing business. Their strategy includes they have higher factor rates because the risk is much higher. They got smaller initial advances because they don't want to overpower or that's not the right word. They don't want to provide more capital than the small business person can afford to pay back. They're frequently reviewed because they're such short term. They can get better and better and better and better rates. Um, they have close monitoring of repayment performance, the risk diversification across many borrowers. So they're in a category with a lot of type of people in their industry, so they know that the risk can be mitigated by a lot of different borrowers in the same industry. And then they got higher pricing, which helps offset the increased likelihood of default. Um, the bottom line is that Bank Breezy platform uses multiple lending tiers. These multiple lending tiers are really what the marketplace model works best at. When businesses are matched up with which tier best aligns with what their profile looks like. And their profile, for example, may be a contractor with a 745 code. They got strong revenue. They got a clean bank statement. They're likely suited for an A-tier lender. Then you have a retailer with a 635 FICO with a few overdrafts. They may receive stronger terms from a tier lender. They may get an A offer, but the B might be even better. Then you got a trucking company with a 565 code. They got existing MCA debt and inconsistent cash flow. We would probably still be able to secure them a C or D tier lender. But using a broad network of lenders increases approval rates. It helps the business receive the most competitive offer available for their specific risk profile rather than applying a one size fits all approach. I'm going to stop there here. So everybody needs to understand that when you get a file in your hand and the guy says, I'm doing 100,000 in revenue. Okay, that is fantastic. That's a big deal. But that $100,000 revenue doesn't hold the same clout as if it's in a trucking company that may be a C or D lender as it would if they were a construction company and they're A tier qualified. So as you go back to and re-look at what we're all about, and you see the some of the underwriting criteria, and you start studying, you realize that A tier, you can get up to 200. I've got 300% before of what they're doing monthly in offers, but usually they're around 150 to 225%. So they're doing 100, they're going to get anywhere from 150 to 225,000 on an A. That same file, if it's a B, may only get about 100,000 what it's doing monthly, and that same file, if it was a C and D, they only get 50 to 75,000 on their first initial funding. We are not going to. David says something better and I start saying it always now. That is that they're not going to give you more money than you can afford. So if a client is talking to me and they say, "Listen, I don't know if I can afford it," well, I'm going to make sure they understand so I can get their comfort level where it needs to be. That you would not have this offer if our underwriters didn't think you could afford it. The question is now, how do you if you need to feel comfortable with what you take, and if you feel uncomfortable with something that even maybe $300 less a week would fix, then you need to take a little bit less funding now and get yourself in the system so that after a period of time, you pay 40 to 50% in, we're going to be able to get you into another structure, a better one, not worse. It's always better than you were before. And then my final thought of the day is this: stacking clients is not what we're about. Sometimes we have to make deals work, and sometimes it makes sense for the small business person because they're in a cash flow crunch. But when we do this, I always look for the very best prepayment discount out there, and there are some really anywhere. I mean, we got them all the way up to 100% prepayment discount. So when we work in your client, we want to give them as much as they want. It's not always possible, but sometimes what they want, they really don't need. And it's really our responsibility not to allow them to be irresponsible. That sounds weird. I know that a lot of folks don't want to hear that because they want to sell. And see, that's the whole problem. You're selling. And what we're doing is we're providing the information they need that's going to solve a problem they have today. Our money's not for a problem they're going to have 2 years from now. It's for what they're going to have today. I don't have anything else, McGuire. I don't know if David wants to comment on anything or not, but I just really appreciate you guys giving me a Tuesday where I can talk to you about these kind of things. I try to bring to you information that I would want to know as a broker.
I just want to say this, buddy. I think you did awesome. I usually don't like to comment, but when we first started, Wade, do you remember? We only had A tier. We only had
Yeah.
A tier lending. And then we moved to B tier to help more clients, and then C, and then D. And now it's very hard to get a decline. I mean, the client, even our D tier providers, want to give funding as long as they can afford it. If someone's turned down, it's because they can't afford it. It's that simple. Wade, you did a great job covering that point. I appreciate you, buddy. Thanks for all you do. And we're always adding more or considering more lenders because there's new ones popping up every day. But it's very hard to displace someone we already have. We've already got the best A, B, C, and D. So it's hard to displace one of them, but we are open to it. Wade does verify and view regularly. So that network will always change. But I think this was a fabulous training. Great stuff. I was taking notes the entire time. Appreciate you, buddy.
All right. All right. You gonna bring them home from McGuire? You want me to?
You can, sir. You've done a great job today. Phenomenal stuff.
Well, I appreciate it. And guys, if you ever are in doubt, ask a question. Don't make up an answer. And asking questions doesn't mean that we look at you as being ignorant or stupid or anything. I mean, quite frankly, I have to ask questions a lot to underwriters, and we want you to do the same thing. We love you. We appreciate you. Keep going out there and talking because I promise you, like my wife has found out, talking to people and giving the information is critical, not selling, but just informing. And that's why I personally think you're not a member of your local chamber or any other association. Become a member, get acquainted with people. Look at it like a shopping spree. Go to every retail store and just shop. And while you're there, hey, say hello. Y'all have a great rest of the